A strategic alliance is like two neighbors agreeing to share a garden fence. They keep their own houses, but cooperate on a specific task, such as technology sharing or co-marketing. Alliances can be non-equity, no new legal entity, just a contract or equity-based each party buys a small stake in the other. A joint venture is more like two neighbors building a shared shed. They create a brand new legal entity that owns assets, hires staff, and reports its own profits and losses. The joint venture can be wholly owned by one partner, a sole venture, or multi-partner with shared equity. Key structural differences: legal form: alliance equals contract, joint venture equals separate legal entity. Capital commitment: alliance may require only modest upfront spend, joint venture usually needs capital contributions proportional to ownership. Liability: in an alliance, each firm remains liable for its own actions. In a joint venture, the new entity bears liability, shielding the parent companies subject to guarantees. Duration: alliances are often project-oriented and short-term. Joint ventures can be long-term strategic platforms. The strategic rationale answers the question why partner. It aligns each firm's goals like two runners deciding to race together because they can share a faster bike. Access to markets: for example, a United States tech firm partnering with a Chinese distributor to enter China. Technology complementarity: for example, a battery maker teaming with an electric vehicle original equipment manufacturer to co-develop a new powertrain. Cost sharing: joint research and development labs to split expensive equipment costs. Risk reduction: sharing the financial shock of a new product launch. Objective alignment requires a clear map. Each partner writes down its primary goal, revenue growth, brand enhancement, learning, and checks where these overlap. Misaligned objectives: for example, one partner seeks short-term profit while the other seeks long-term capability building, often cause friction later. Good governance is the traffic light system that tells partners when to go, slow down, or stop. Board composition: in a joint venture, the board may have equal seats for each partner, parity board, or be weighted by equity share. In alliances, a steering committee with representatives from each firm performs the same role. Decision rights: define which decisions need unanimity, for example, capital expenditures greater than $10 million, which can be made by a single partner and which follow a voting rule, majority, or supermajority. Control mechanisms include veto rights, drag-along, tag-along clauses, and information rights, regular reporting. Operational control: for day-to-day running, appoint a joint manager or a lead partner to avoid duplicated authority. Clear governance reduces ambiguity, speeds up actions, and protects each firm's strategic interests. Valuing a partnership is like pricing a movie ticket. You look at expected cash flows, discount them, and sometimes consider the optionality of future scenes. Net present value (NPV). NPV equals sum from T equals 0 to N of CF sub T divided by open parenthesis 1 plus R close parenthesis to the T, where CF sub T is the net cash flow in period T and R is the discount rate, often the weighted average cost of capital of the joint venture. A positive NPV means the partnership creates value for both parties. Internal rate of return (IRR) solves for R where NPV equals 0. Compare IRR to each firm's hurdle rate to see if the deal is attractive. Real options: partnerships often contain option-like features, for example, the right to expand, abandon, or inject more capital. The Black-Scholes or binomial approach can value the option to expand. V expand equals C0 times phi of D1 minus X times E to the minus RT times phi of D2, where C0 is the present value of expected cash flows, X is the investment cost, T is time to decide, and phi is the cumulative normal distribution. Profit-sharing models: equity-based, profits are split in proportion to ownership, for example 60-40. Contribution-based: allocate profits based on each partner's cash, IP, or asset contribution, for example 70% of cash contributors, 30% of IP contributors. Performance-based: use a sliding scale where a partner that meets certain milestones receives a larger share. The chosen model should reflect the risk each partner bears and the value of its inputs. Every partnership carries risk just like a road trip carries the chance of a flat tire. A risk allocation framework decides who pays for which tire. Identify risk categories: market risk, technology risk, regulatory risk, execution risk, financial risk. Allocate based on control. The partner that can best manage a risk should bear it. For example, the local partner handles regulatory approvals in its country. Mitigation tools. Contractual clauses, for example, indemnities, warranties, force majeure. Insurance, political risk insurance for cross-border joint ventures. Milestone payments. Release funds only after certain technical or commercial milestones are achieved, reducing upfront exposure. Escrow accounts hold a portion of cash to cover potential cost overruns. Risk-sharing formulas. For example, a profit-sharing rule that includes a risk-adjusted return factor. Share I equals contribution I to the beta divided by the sum over j of contribution j to the beta, where beta is greater than 1, tilts the share toward the higher risk contributor. A transparent risk allocation plan prevents disputes later and aligns incentives to manage uncertainties. When two firms join forces, they must obey competition law the same way two drivers obey traffic lights. Antitrust concerns arise if the alliance could lessen competition, raise prices, or create a dominant market share. Horizontal alliances between rivals are scrutinized closely. They may need notification to competition authorities, such as the United States Federal Trade Commission and European Union Commission. Vertical alliances supplier-buyer are less risky, but still require review if they restrict downstream competition. Legal steps. Pre-competition analysis, market definition, Herfindahl-Hirschman index calculation, and forecasted post-deal market share. Filing, submit a merger notice if thresholds are met, such as European Union €5 billion turnover or United States $92 billion assets. Remedies may include divestitures, behavioral commitments, such as non-exclusive licensing. Other legal considerations. Intellectual property rights, who owns new IP. Governance documents, articles of incorporation, shareholders agreement. Compliance programs to avoid bribery, sanctions, and export control violations. Understanding the regulatory landscape early avoids costly delays or forced unwinding of the partnership. Measuring success is like checking the speedometer while driving. Key performance indicators, KPIs, must be tied to the alliance's strategic goals and be quantifiable. Typical KPI groups. Financial, revenue contribution, EBITDA margin, cost savings realized, return on investment. Strategic, market share gain, number of new customers acquired, product development milestones met. Operational, on-time delivery rate, defect rate, research and development cycle time. Compliance, number of regulatory breaches, audit findings. Design tips. Smart, specific, measurable, achievable, relevant, time-bound. Balanced scorecard. Combine leading, for example, number of joint patents filed, and lagging indicators, for example, joint revenue. Weighting, assign weights to each KPI to compute an overall performance score. For example, score equals 0.4 times revenue growth plus 0.3 times cost savings plus 0.2 times milestones plus 0.1 times compliance. Regular reporting, monthly or quarterly, and a joint performance review board keep both partners honest and allow early corrective action. Every partnership should have a clear plan for how to part ways, just like a lease agreement spells out when a tenant must move out. Exit strategies fall into three broad categories. Contractual termination, pre-defined end date, or a break clause that allows one or both parties to exit with notice, for example, 12-month notice. Buyout provisions, one partner can purchase the other's stake at a predetermined formula, for example, fair market value based on latest audited financials, or a multiple of EBITDA. Automatic dissolution triggers events such as failure to meet a critical milestone, insolvency, or a change of control of a partner. Dissolution mechanisms include asset division, allocate tangible assets such as equipment and inventory and intangible assets such as IP and brand according to ownership percentages or separate valuation. Debt settlement, agree on who assumes existing liabilities. Non-compete and confidentiality, post exit restrictions to protect proprietary knowledge. A well-drafted exit clause reduces litigation risk and provides a clear roadmap for unwinding the partnership while preserving goodwill. Question 1 Valuation and profit sharing. A US software firm and a Japanese hardware firm form a 50-50 joint venture to develop a smart home device. Expected cash flows in dollars millions over 5 years are: year 1 equals 10, year 2 equals 20, year 3 equals 30, year 4 equals 25, year 5 equals 15. The joint venture's cost of capital is 12%. A solution framework. 1. Discount each cash flow. PV sub t equals CF sub t divided by 1 plus 0.12 raised to the t. 2. Sum PVS to obtain NPV. 3. Compare NPV to 0, value creating if positive. 4. Cumulative cash flow timeline, 10, 30, 60, 85, 100. The first 30 million is reached at the end of year 2. Remaining cash equals 100 minus 30 equals 70 million. Split remaining cash 50-50. Each gets 35 million plus 15 million each contributed up to the 30 million threshold, that is 15 million each. Total per partner equals 50 million. Question 2 Risk allocation. 2 firms share development risk of a new drug. Firm X contributes 40 million in cash and owns the patent. Firm Y contributes 20 million and handles clinical trials. If the project fails with probability 30%, losses are borne proportionally to contribution. A solution. 1. Total contribution equals 60 million. 2. Loss share X equals 40 divided by 60 equals 66.67%. Y equals 33.33%. 3. Expected loss equals probability of failure times total loss, which is the total contribution. Expected loss X equals 0.3 times 60 million times 0.6667 equals 12 million. Expected loss Y equals 0.3 times 60 million times 0.3333 equals 6 million. Question 3 Antitrust threshold. A European joint venture between 2 telecom operators will have a combined market share of 35% in a market with an HHI of 1,800 before the deal. A solution. 1. Pre-deal HHI equals 1,800. 2. Contribution of the joint venture to HHI equals 2 times open parenthesis 35 squared close parenthesis minus sum of individual shares squared. Assume each had 15% share, so individual squares equal 2 times 15 squared equals 450. 3. Joint venture square equals 35 squared equals 1,225. 4. HHI increase equals 1,225 minus 450 equals 775. 5. Post-deal HHI equals 1,800 plus 775 equals 2,575. 6. Increase greater than 250 LUDs to mandatory notification. Framework for answering. Identify the concept being tested, such as valuation, risk, or antitrust. Write the relevant formulas. Plug numbers step by step. State the conclusion clearly. For essay-type questions, structure answer.